President and Lead Analyst at Capital Markets Advisors, Rohrbach International. We are in the clarity business. And right now, clarity is once again a little harder to come by than a few weeks ago when the moves may have been completely hyper-volatile, literally violent short-term trends, but the market's churning a bit more now. But the U.S. equities are holding up, and we want to explore a bit about, well, why are they holding up with the various negative news impacts out there? And as the title of this broadcast suggested, we're going to explore the concept of normalcy bias. Normalcy bias is when things are coming that people know are bad, accidents, natural disasters, etc., but instead of having their fight or flight instincts kick in and cause them to do something, they sometimes become very calm and just pretend everything is normal, ergo the normalcy bias. And right now, as we look at the weekly chart of the S&P 500, as we are inclined to do at the beginning of these broadcasts to look at the technical picture, we've had a lot of history. We've been over in other broadcasts, so I'll keep this brief. After the overall uptrend, the significant rally out of January 2016 through February of this year, with a significant sideways action and interruption, sharp correction and recovery into December of 2018, the market came under extreme pressure. Now, just to recap what happened there, the market ended up, of course, on the macro front being impacted by the COVID-19 contagion, and that put through some bearish contagion in the market, back down from the highs near 3,400 and back through the key congestion out of last July and September at 3,030. And along the way, that wasn't just an old congestion area. On the channel projection from that significant December 2018 low, we used the trajectory of the highs to predict the idealized channel support off of that major low, and that was around 2970 into early March of this year. So 3030 to 2970 is a key area the market broke down through. There were interim levels along the way, but the fears that the federal government and the Federal Reserve were not going to come through with enough of a relief package or stimulus drove the market straight down to the broader channel. The highs from January of 18 and February of 2020 gave us that trajectory for the idealized support, the broadest, in fact, idealized support off of that 2018 low, and that was 2620. And as we know, the macro factors remain muddled, and the market was upset with that. And then finally, the U.S. Congress got its act together, approved the relief package. Of course, that helped the market recover back above 2620, along with the secondary package, and push back up across time through these interim levels, 2750, 2850, and ultimately churn against the low end of this 2970 to 3030. Now, in anticipation of, and then on the event of the strong U.S. employment report going back several weeks ago, again, 2 weeks ago on this chart that's current through last Friday, I mean, this was 3 weeks ago, it got out above 2970 to 3030. And for all it's already made a big move up, the next area that was critical was not until up around 2600. And of course, we had the fine line resistance off the internal congestion, and we'll study more of this later, up into the 3230 area, right where the market topped several days into the beginning of the week 2 weeks ago. This was right into some fundamental influences we're going to get back to a little bit later. But then once those were negative, especially the Fed not promising any further support, where do we go? Well, there was not much between 30.30 and 32.30. Well, the market went right back down to 30.30 to 29.70. That it actually washed out a little bit below last week before coming back. And of course, the key here is knowing where to look. The market price swings are communicating. It's telling you what the market thinks of itself. I've got all manner of people all over the place saying, oh, the market should be doing this. I think the market should be doing that. I think this, I think that. Well, the market is also, with its activity in these critical areas, telling you what it thinks of itself. And that's where we always get back to mentioning the market is like the Rosetta Stone. You know, again, this is the archaeological find French troops made in Egypt in the very late 18th century. And the top two sections are Egyptian hieroglyphics of various forms, which they were having trouble reading in the historic community at that time, in the archaeological community. The bottom section is ancient Greek that they well knew how to read, and by referencing this against the Egyptian hieroglyphics, they were able to see what the hieroglyphics meant that much better. So we're asking now, well, what's the market going to tell us next? Is it going to come back after coming back last week to close, well above 3,000 after it ranged above 3,100 to 30 that we'll revisit again a bit later? Is the market going to end up pushing above the 3,200 to 3,230 area? That opens the door to getting back to those old highs. And the other side is it going to end up closing, not just temporarily trading below 29.70, in which case it's back in this lower range and probably headed lower. And the question really is, well, why would a market that's already come back this far from a disaster into some deteriorating news on the COVID-19 contagion and infection front, why would it possibly find buyers up here who want to keep buying it at elevated levels? And that's where we get back to our fundamental factors. Now, again, we have looked at this a bit before, but 2 weeks ago Wednesday on the 10th, the OECD issued its World Economic Outlook. And what we know is the world economy is on a tightrope. And even if there is a recovery, the chances are pretty good. There's been so much damage. You can see the degree to which they are talking about the shrinkage in the European and U.S. economy. And also, for all there will be a V recovery of sorts, it's going to be limited. It's not going to be the big, recovery to the growth path we were on in 2019. And they bothered to include this animation, which I'm going to revisit again, because we've had some further projections on this front we're going to get back to shortly. And compared to the 2019 expected growth path over the next couple of years, this is what the initial COVID-19 hit did to the economy. Now the question is, do we end up with a second wave, or what we're seeing now, it seems in the US, at least a significant extension of the first wave that we'll discuss further shortly, that is going to restrain economic growth, and yet the market stays up near these higher levels, up near the old highs, up into higher levels. Once again, this is the short link of this entire long link up here that you can use to look for yourself for the actual full OECD report. That's Organization for Economic Cooperation and Development, who's very good on their research and projections. Normally a monthly composite leading indicators that can tell you what to look for 4 to 6 months out. So this is where, when I say we're in the clarity business, it's because we start from that broader view from 30,000 feet perspective. And this is one of the primary resources we rely on. So by all means, make use of that if you care to review that report. But just yesterday, So 2 weeks after OECD, the IMF came out with its growth projections, and this major downgrade for 2020. Back in April, they said, well, maybe it's going to shrink by about 3.5% for the advanced economies. Now it's down to 8%. That includes near 8% for the US and more than 10% economic shrinkage for Europe. And therefore, even though you see, well, but we're going to grow 4.8 in 2021, obviously, just as the OECD graphic showed, that's really only going to make up part of the move back toward the kind of growth trajectory we're on in 2019. So this is a rather lengthy macro review, and it's all leading to the further discussion of that normalcy bias. Here as well, now that was extracted, that graph, from the International Monetary Fund World Economic Outlook. So rather than having to search engine that and find a longer link and whatever, here's your short link to get to the main page. You can get the full report. You can see that graphic. You can link into the 40-minute press conference where they discuss all these different factors. But where does this all leave us? It leaves us with a report also that was released yesterday by Vox. And Vox did an excellent article. And once again, here's the short link to that article. So this is the key graphic from that article, but there's other graphics in there and extensive explanations of what's going on. And the bottom line, amidst all of this push to say, well, we're reopening, we don't care about higher infections, we're just going to keep going, is this view that only 7 states have actually done enough to meet the government, meaning the White House, the Trump administration criteria for what you should be doing in terms of testing, reduced infection rates, hospital capacity, to allow you to reopen. But they're reopening anyway. So obviously they have a bit of normalcy bias. I mean, look, everybody is just hoping things will get back to normal and that we are going to see something, less daunting in terms of all of these problems. But of course, if wishes were horses, beggars would ride. And in this case, what we're getting is the disconnect between this desire and people who aren't even following the protocols. You've all seen the significant number of news reports, event coverage, etc., starting back at Memorial Day, but consistent in a lot of the areas of the U.S. People are just refusing to wear masks. Now, that's the one thing, including all of the physicians and scientists on the White House Coronavirus Task Force agree upon, and that is the masks help suppress the spread of the infection. And it's not a matter of they're protecting you. This is about, as Governor Inslee put it in Washington when he made masks a requirement, it's about consideration and care for everybody around you. But it's not happening. Hey, it's a free country. They don't have to wear them. But I also think people have a significant normalcy bias if they think a lot of people not wearing them are going to end up not fomenting more of a spread of this disease. And specifically on normalcy bias, and that was a term that I ran across in a book that a friend got for me as a holiday gift. You'll notice down here that it was almost a tongue-in-cheek joke, given he's someone else who's actually very intelligent and likes looking into the oddities of life and the world. But he gave me a book as a gift saying, "You are not so smart." There's probably a lot of people who think that, whether they actually say it to me or not. But David McRaney, 2011, and he has a brief chapter on normalcy bias, on this particular consideration that the received wisdom is that fight or flight instincts will kick in to trigger immediate action when there's a threat or an actual disaster happens. Well, the reality is that when things look like they are really bad or they're going to be really bad, a lot of people, by some psychological studies cited in the book, 70% of the people become abnormally calm. It's not like they're frozen in place with fear. They just assess it and compare it to previous experience and go, well, you know, things tend to work out, and they are, you know, kind of less than attendant to the threat, which we've seen very much with hurricanes along coastal areas, tornadoes in the Midwest, winter storms in the northern plains in the Midwest, and even out east. Everyone remembers the combined storm, Superstorm Sandy. A lot of people just said, I'm going to ride it out. I've been told things are going to be bad before, and, you know, I just stuck it out. In McRaney's book, among the worst historic examples that I am providing you here is Tenerife is an island in the Canary Islands off the coast of Spain, a big holiday retreat for the Europeans. And it's extremely foggy one day in 77, and cross signals where the tower couldn't see any of the planes in the airport and the planes couldn't see each other. Literally pea soup fog, and they were relying on communication back and forth between the tower and the planes, and there was a missed signal. And one major jumbo jet was coming in one way, and another jet was starting to take off, and they couldn't avoid each other. And the top half of a Pan American 747 got sheared off, but was sitting there on the runway and didn't explode for like 20 minutes after that happened. Of the 496 passengers on that plane, only 70 of those who weren't immediately impacted by the collision made it to safety, despite this obvious life-threatening situation. The rest were sitting there, maybe some in shock, and maybe some just saying, well, let's wait for the flight crew to instruct us what we need to do next. Who knows? But 70 made it off. A lot more could have made it off, but they didn't before the fuel tanks finally exploded and killed anybody who was left. Now, this is a horrific story. And it is, though, just sharing with you how sometimes people who get serial communication about things are bad. They're bad, and it seems they're deteriorating, like we are seeing now on the virus and the ultimate projections for the stabilized level of economic turnover, even once we get back to a more open economy, which is reversing in some places. Don't forget, the governors of New York and the New York and New Jersey and Connecticut are all in a position where they are now basically killing inbound travel from many of the highly infected areas. And they're doing that by requiring a 14-day quarantine for anyone who comes in from the high infection states. So that's a new piece of news that is just further limiting the attempt to open. So now what we're getting is the degree to which we look back at 2007, 2008, and we end up, and we have the serial consideration of the degree to which things were bad and getting worse, on housing prices slipping, mortgage-backed securities being a problem for banks, et cetera, et cetera. and we still ended up with people friendly the market, even as it slipped out of 2007 into early and then mid 2008. And of course, it finally took the hit. And the question is whether now we are going to maintain this support at 30.30 to 29.70, or we are going to push above the higher level. My guess is we're going to end up failing, but I will wait for the market to tell me that it's ready to do that. And that's pretty much it for me today. Now, I understand we have a special guest, Ticker Talker Global Business Development Director, Bill Berry, waiting in the wings. And let's go ahead and allow the producers to click us into that right now.
Hey, Alan, how are you?
I'm just fine, Bill. How are you?
Terrific, thanks. Thank you very much. A very kind introduction. I appreciate that.
Sure. Let me just clear my screen here so that I can make sure that I'm also seeing this. And Bill, I especially wanted to have you on today because we're looking at this significant growth that Ticker Talker has experienced. I know you are in the thick of all that, and I'm very interested to hear just how Ticker Talker has accomplished that and what you're seeing in terms of the further developments.
Sure. Thank you for that. How they accomplished it, smarter people than me, working really hard to make this thing work. I'm an old guy, and social networking and all that goes with it is kind of foreign to me. I'm an old-fashioned steak and potatoes kind of guy, but we have been able to very successfully grow the platform with a team of very creative social media experts that make up our creative team. There's been a redesign with our launch date was in January of 2020. There's been a redesign of our user interface. It's a continuous process. We are constantly swimming like a shark, right? You can't slow down, you keep going. We've experienced in the last 6 months now, we've experienced a 500% increase
Wow.
in our user base. Ticker Talker TV, which we're being broadcast on now. I have my Tuesday at 3:30, the Ticker Talker Roundtable, which hopefully you'll join us for at some point in the future. As a celebrity guest host kind of thing. Very creative sort of content that folks can enjoy and learn from. Ticker Talker TV now has more than 10,000 subscribers. We have more than 325,000 monthly impressions. That was something I had to say, what is an impression? What is that? And that's somebody clicks on us. That's called an impression. That's up over 375,000. And I think a big part of our growth is the diversity and the types of leaders that we're bringing on board. You, Alan, and you and I have known each other for a long time. You being a perfect example of a leader who's joining us here on the platform, who has, first of all, a wealth of knowledge that he can share with the investing public, and
Bill,
secondly,
if you stick around long enough, you remember a thing or two.
Very good. Yes, indeed. So you look at things, as I understand them, more intermediate or long-term. You're not just a stock picker. You're not the flavor of the day kind of guy. So while you certainly can focus your technicals and you can certainly focus your sites onto the immediate, right? Now
Right,
casting,
absolutely.
it's very important and equally as important to be able to see the long term, to be able to see over the horizon, to be able, it's one thing to see with the naked eye, it's another thing to put on some binoculars and look down the road. And as I always like to say, you're not looking in the rear view mirror. Here's what happened always. You're looking through the windshield, what the upcoming traffic looks like, what's on the horizon. And that's very important. We need to understand history, we need to understand historical events, and we need to have perspective, but we also need to use that perspective to kind of figure out where we're going to be tomorrow and the day after tomorrow and 6 months from today. On my show on Tuesday, we talked about the last 6 months, but more importantly, we talked about the next 6 months. And I'd like to get some really long range forecasts in areas like that you specialize in, interest rates and foreign currency trading and global macro economic type situations. So I credit our success to a very creative team of knowledgeable people about social networking and an influx of extremely competent leaders such as yourself, who are focusing not just on the immediate, but also focusing on the intermediate and medium and longer term.
Right. Well,
Um,
Bill, that's a very good point, and that's why I call what I do the evolutionary trend view. And that's a very fancy term for what? Something everybody who uses charts knows, and that is the degree to which it's all retrograde analysis. You have to know where you've been. Now, one of the key things we covered in my previous segment on Monday, I talked about people's scope of analysis and projection. How far back are you reasonably going? Well, that's really driven by how far forward you want to project. But we
okay.
know everyone wants to review history somewhat further back than how far they're projecting. If you're a day trader, you're going out looking for a trade you can be in for several hours. You're not just going back 3 hours in history and going, what happened the previous 3 hours? Chances are you're going back several days or even several weeks. I'm someone who evolved out of a short-term beginning on the floor of the old Merc as a order clerk, and was watching pork bellies day, literally intraday swings. And I had great mentors, and I managed to take their guidance and my desire to say, all of a sudden, after you get past that one day, once you're holding things overnight, you go, well, once I'm going to take overnight risk, I could sit with positions longer term. So I started going, further and further out on, hey, what could be coming? Like you said, what might be
Mhm.
coming up 2 months, 3 months, 6 months? That
Of
is a
course.
scenario. You don't have something too specific, maybe, but it means you're going back at that point. You're looking at charts that go back 5 years, 10 years or more, wherever the last significant major cycle high or major cycle low was, in order to be able to have the context you need to move forward, not just hang out looking at history. As you said, that doesn't accomplish anything in its own right. It's there for a purpose.
Yes, absolutely. So, Alan, your story I think is particularly interesting and would be interesting to our listeners or viewers because of the fact that you are part of that long in the past exchange floors, and I'm just curious how a guy like you, who began as a runner, as you mentioned, down on the floor of the old CME, which was a meats and eggs and poultry market,
Right.
how do you make that transition? How do you end up as an international, global institutional investment market advisor, and most importantly, an educator? How does that transition occur? Obviously not overnight. Tell us a little bit about how that happened.
Well, you're right. The first rule of thumb, as in most businesses where people develop some standing, is tenacity. And you run into some times when what you're doing doesn't seem so effective. You know, there's that old joke about with surviving in their business, politicians and prostitutes gain respectability. Well, it's a little bit that way. For market analysts as well. They figured, hey, if this is how you've been making your living and you're around 50 years later, maybe you know a thing or two. But how it transpired, of course, is an interesting story that, of course, I'll give you the the concise version, and that is moving from those very short-term observations, literally looking at the volatile pork bellies, which were they've been delisted now, but it's literally the late great pork belly market. When you walked onto the floor of the Merc as a clerk, and every day around 9:15, there are a bunch of grown men in colored jackets wearing these badges, jumping up and down like it's a rock concert. And you go, well, there's some real energy there. You know, you're a punk, you're 20 years old, and you're going, what is this? And when they explain price discovery and the fact that, you know, this is, I said, well, who sets the prices? And they said, well, nobody sets them. It's literally guesswork by everybody. It's a puzzle they come in and work on every day. And after years of shifting majors in college, I went, you know, this is what maybe that whole diverse education was preparing me for. And we started studying it. And along the way, we stopped looking at just intraday swings, and we started saying, hey, there's trends going on here. And we had some great mentors. You know, many of them, may they rest in peace at this point, but me and some friends are forever grateful to people who said, well, you should be looking at charts. And then we used the charts up to the limit of what we could get from them. And they said, start looking at moving averages. They spoon fed us, literally, step by step, overbought, oversold. Once the averages gave us what we needed, but then we needed more. And across time, you realize something else that I also covered in that last broadcast I did under the, you know, general context of price trend analysis. Aside from the scope of your analysis, it's also the kind of tools you're using and the decision process. And you suddenly realize part of that is saying these various techniques, chart patterns, averages, overbought, oversold, etc., just like I'm sure Steve Kalasian and your other shorter term analysts have done many times in their rooms and in their webinars. It's like it's portable across time frames. It's fractal. It gets back to the old fractal idea of things that'll work on a daily chart will work also on an hourly chart. They'll work on a 15-minute chart, or work on a weekly chart, which you've seen my charts in these broadcasts. I tend to focus on the weekly for the bigger trend view. And we went through that, and what happened is, this is the seminal factor in me moving from the futures broking business to where I was no longer a trader, I was a customer's man, to providing advisory, was the negotiated commissions that were officially started in 1975. Well, by the late 70s, they started to bite. You really started to get discount houses, and everyone was saying, well, I no longer want to pay $50 a contract for trading my bellies or wheat or gold or whatever it was. I can get that done for $9 a contract. Well, as someone who was taking...
If you were in a meet, you remember Lee Castee, right? He was a meets guy, and he started Index Futures Group.
Exactly. And you got a lot of these people who went in the brokerage business because it was a good business back at that time. But then I'm sitting there going, the commissions have shrunk, which I get only, part of. I get like whatever it was, 30 or 40% of the retail commission. The commissions have shrunk from $50 to $15, and I'm holding positions for 2 months at a time. And I finally said, you know what? I'm going to put a patina on it, put together some marketing materials, put out formal written notes and letters starting in 1981. And I'm going to go to commercial users, to banks, insurance companies, real estate companies who need some guidance. Back when Paul Volcker was moving the interest rates around, as you recall, he was moving around 3 or 4% up and then back down in every quarter. And the people who had to reprice their debt were getting killed. And that's when RIIver International was born, out of seeing a condition where the kind of shorter term, fine line trend decisions I was able to provide people at that time. The bank research departments were still giving people where the yield was going to be on average next quarter. Well, that's fine. But in the meantime, the actual repricing levels could be 2% above the average or 2% below it. And that's a lot of money. And that's where they were able to justify taking me on as an advisor. So there's the quick and dirty version, how I went from handing orders over shoulders of guys, John, market order, etc., to being a guy who sits here and watches the world go by on an international front as well, thanks to some people I was introduced to from London as they were deregulating in the early 80s.
Well, Alan, that's a great story, and we could, you and I'm sure, and a pitcher of beer could spend quite a few hours talking about the good old days. I think what's critical to understand is that wealth of knowledge that you have translates wonderfully into modern times. And
yes,
that's why you're able to so successfully analyze the markets that we face today.
And also that along the way, one of the things, because we started in the ag, and we picked up technicals very timely when we started, me and some of my friends who are still in the business. We ended up initially looking at the fundamentals. We were the old B.J. Linden Company, long before it became Lind Waldock. But he was already partners with the Waldock brothers, and we were looking at a pipeline into the fundamentals on the hog and pork belly market. And we started off as fundamentalists. And then, of course, through the good offices of Leo Malamed and the whole team from both the U.S. government and the exchanges who got the financial futures approved, the currency futures approved, suddenly we had markets we were looking at that had to do with the whole world. So we've been looking at government activity, central bank actions, how the markets respond, how to anticipate what's coming next since, the better part of 50 years, since the early 70s. And it's the context. That's the macro side, which I always stress in my analysis and in my broadcast for Ticker Talker. As you know, Bill, I say, all right, yes, here's how the market's trading. And now let's talk about the fundamental influences and how it's responding. And it's macro technical. I mean, if someone's got an algo that they think is good and they're evolving it and it's making money, more power to them. Great. But if you really want to look at trends and be in positions on a sustained basis, you have to have both sides of the equation. There is no technical versus fundamental, as some people used to say in the old days. They are different sides of the same coin that have to be employed in the context of each other.
Absolutely, I agree. Absolutely. Well, Alan, I appreciate you giving me the opportunity to come on and talk with you. Glad to be able to give our viewers and particularly your viewers an opportunity to understand the Ticker Talker platform and to be a part of our success. Much obliged.
Well, and it's great to see a lot of people have attempted social market platforms in the past. This is not new, but I think the combined talents of Ticker Talker that was already had talented people providing quality information, and F Creative, who I know is now an integral part of the merged
Right.
entity. And
Yes, it is.
F Creative is an award-winning product development and marketing firm. There's very few platforms that could have convinced me to add the extra effort to my institutional research and client contact. But as you know, Bill, when you told me about the further developments here and how things were going and the focus on also interesting larger entities along with individual traders and taking advantage of this, I jumped at the opportunity, and I certainly thank you for that. And good having you on here. And I'll be happy to come on your broadcast as and when it works for you.
Terrific. We'd love to have you.
And with that, I think it's a wrap.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Thank you for joining Roar International on Ticker Talker. We hope you found the insight beneficial and look forward to providing you further advantages sometime soon. Bye for now.